We've all heard it. Housing affordability has hit rock bottom. But what does that actually mean? And more importantly, what does it mean for you? The answer depends on where you live and whether you're renting or trying to buy. That's why we launched the Housing Affordability Composite Index. It sounds technical, but stick with us. We're going to break it down.
There are already affordability indices out there, but most of them only tell part of the story. Many focus entirely on price, and price matters, of course, but affordability is about more than just a sticker price. It's also shaped by the income needed to pay rent or a mortgage, supply and demand pressures, and how much money households have left over after essentials. Another important piece that many indices miss, the rental market.
By looking at both the rental and buying markets, we get a more complete view of affordability. We also break it down by region because national headlines can hide what's happening on the ground. We often hear about housing pressures in Vancouver and Toronto, and those markets absolutely matter. But if we focus only on those two cities, we miss what's happening elsewhere in the country. When you break it down by market and region, the picture can look very different. Let's start with home buying.
Home buying affordability recently fell to its lowest point since the 1990s. In the early 2000s, and again in 2015, affordability declines were largely driven by Vancouver and Toronto. But in 2020 and in 2023, pressures spread more broadly. Ottawa and Montreal, for example, saw rising competition amongst home buyers, in part due to the pandemic and remote work reshaping where people chose to live. And if we only looked at the most recent years, we might miss something important. The erosion in affordability didn't happen overnight. It began in the early 2000s and built gradually over time.
Despite those sharp dips, it did look like things were starting to improve. So, is there good news?
There are reasons for cautious optimism. Since 2023, we've seen slight improvements in some regions, particularly in Ottawa, Toronto, Vancouver, and Halifax. In Montreal, Calgary, and Edmonton, affordability appears to be stabilizing. That doesn't mean challenges are gone, but it does suggest momentum may be shifting in some markets.
If you've looked at other affordability indexes, you may have noticed something missing. Most of them don't include the rental market, and that's a major gap. Let's talk about it.
Rental affordability pressures rose quickly in recent years. In 2022 and 2023, rising inflation and strong population growth drove much of that pressure. But in 2025, we started to see early signs of stabilization at the national level. Again, not solved, but potentially shifting.
One in 3 Canadian households rent. So if we ignore renting, we're ignoring a significant share of the population. But it's not just about representation. It's about how renting and buying influence each other.
If we only look at one side of the market, we miss how interconnected the rental and ownership markets are. Take Toronto and Vancouver. There are currently many condo units available in those two markets. When condos don't sell, they often become a rental unit. And that increases rental supply. What does that mean? More options for renters, higher vacancy rates, slower rent growth than we might otherwise see. That's a clear example of how the ownership market directly affects the rental market.
So why does CMHC's Housing Affordability Composite Index matter? Because affordability isn't just about today's price tag. It's about financial stability. It's about opportunity. It's about whether households can build a future. By looking at both renting and buying, and by breaking it down by region, we get a clear understanding of where pressures are strongest. And that helps us identify what kind of housing solutions are needed. Because better data leads to better decisions.